Hello, this is Will Allen with Centera Capital. Well, we are in the heart of March Madness, hence the shirt, and I will get into that in just a little while. But for today's market update, we are going to be talking about inflation, about the US economy, and the Fed. And today we bring back Evan Temple, who is our creative director here at Centera Capital, but today he's coming back as a client. Evan did a video with us back in August asking questions from a client's perspective. We got very good feedback from clients about that, so he's back today. Let's get into it. Now, before we get into today's market update, just a reminder to like and subscribe statistically. Now, before we get into today's market update, just a reminder to like and subscribe. Statistically speaking, we know about 80% of you are not subscribers, though many of you think you are. So go ahead and hit that button and turn the notification bells on. That way you won't miss a video in the future. So Evan, it's good to have you back.
Good to be back, man. Hey, that intro was fantastic.
Well, I appreciate that.
He's coming a long way. I love it.
Thank you very much.
So before you get into it, I want to know what we're doing here with this shirt. This isn't the usual attire.
It is not the usual attire. So as you know, I am a huge March Madness fan, a big college basketball fan. In fact, I took off last Thursday and Friday for the opening round. In my entire life, I have never gone to school or work on those two opening round games.
Gosh.
But the reason I'm wearing this shirt is that the team I've loved for a long time, the NC State Wolfpack, were not even supposed to be in March Madness. In fact, they were going to be firing their coach because they didn't have a very good season. They won 5 games in 5 days in the ACC tournament, including beating powerhouses Duke and North Carolina. And so
you're jazzed up. You're excited.
I'm jazzed up. And then now they're in the NCAA tournament. And last weekend they won 2 games. They're now on to the Sweet 16, which for NC State fans, it's been a long time since we've had that.
Congratulations to them.
Yeah.
Okay, so cool guy stuff. Now we're going to get in some nerdy stuff.
Absolutely, absolutely. Get into the nerdy stuff, the markets update. And I thought what we'd talk about today, the first topic, is inflation. And I know this is a topic you have had some questions on.
Yeah. So inflation boggles the mind because I don't know where it's going. I know that my groceries are astronomically expensive. So I feel it with the pocketbook, but I'm not really sure what's going on. And I want to know when we, with our dollars, catch back up to where the market's going.
All right. So we got a couple topics on this, or a couple charts here. But I want to first start off, I printed off a copy for you of a Wall Street Journal article, and we'll put the title up for folks to see.
I'm going to read it. We still don't believe how much things cost, and I agree with that statement.
Yeah, absolutely. and the subtitle there says, the high prices of items like coffee and milk have consumers grumbling about inflation across the board, even as it's cool.
Can I throw a couple things in there? So I'm going through Chick-fil-A. It's astronomically expensive. Okay. I'm looking at my nest egg and I'm going, is this thing just been halved in the past 2 years? My property on my house has almost doubled.
Yeah.
Your take?
Well, no doubt that price levels have gone up a lot. And so the relationship between the inflation rate and the price levels is something we should examine again today. We talked a little bit about this in a video in mid-November, but it's very important. So I thought, because you had this question, we would revisit this. Yeah. So why don't you go to the second chart there that you have?
Got it.
And and we'll put this up for folks. This is 3 different measures of inflation. Okay. Producer price index, consumer price index, and then the PCE index, which is something that the Fed follows.
Is this the big 3? Is this the big 3 that tells us what's going on?
Yeah, this is measuring the rate of change year over year. Okay. So you can see that from 2014 through about 2020 that price levels were going up at 2%, 3%,
Sure.
1.5%, in that range year after year. That's what people were kind of used to, right? Then we had the big spike in 21 and 2022.
I see that
and
spike.
You can see the spike with all three of these indicators. And for the peak, these were anywhere between 7.5% and 11.5% year over year.
Jeez.
Now, when people look at this chart now and they see that the inflation rate has come down,
I noticed
okay, what they say is what you mentioned earlier. Wait a minute, the inflation rate's come down. I'm still paying so much more in so many areas, right?
Sure.
All right. So to answer and square that issue, how do you to kind of solve that? Let's go to the next chart. And this is looking at the consumer price index itself. Okay. So this is not the rate of change year over year. This is actual price levels.
Okay.
Take a look at during that same 2012 to 2020 time frame, and you can see that prices were slowly but surely going higher.
Has this ever happened in our history before? I'm sure it has.
It did in the 1970s. We had price levels skyrocket at that time also.
And you're going to tell us how long
Yeah.
it took to level off.
Yeah,
Okay.
exactly. But what you'll notice here is that price levels went up substantially in 2021, 2022. And so what has happened of late, notice prices are still going up. If you look at this chart in the
noticed.
last 6 months, 9 months, prices are still going up, but they're going up at a much slower pace. They're going up at that 2.5%,
Sure.
3% that we just looked at that previous chart. So that's the thing, is that the Fed's job was they substantially increased interest rates because they were trying to cool off inflation. They
Right.
did not want the inflation rate growing at 7, 8, 9, 10%. So they've been able to, and it's not just them, there's other reasons why inflation's come down also, but they've been able to be part of the solution to bring interest rates or bring inflation rates back down. But a lot of people are still unhappy because they say, look, price levels are still much higher than they were a few
Right.
years ago.
Yes, as the term stagflation is being thrown around. Are we in a stagflation model?
We are not.
And explain what it is.
Okay, so stagflation is when you have very high inflation and at the same time you have very low economic growth.
Got
The
it.
economy is struggling, it's flatlining or growing just slightly. We don't have that issue now because the economy is growing at a much faster clip
Yes.
than what many people thought it would be growing at just a few years ago.
And y'all predicted that. I remember
Yeah.
you saying in a previous video that wasn't going to happen. So I give you a point there. How long can we go before we see a turn? Obviously, that's what everybody's thinking. Or are we in a pretty safe spot?
Well, let's recap real quick
Yes.
because we know that a year and a half ago, we basically had 90% of economists were projecting a recession.
That's right.
Okay, for the economy. We believe that with the combination of a very strong jobs market plus the fact that consumers still had excess savings, meaning they had more money in their checking and savings accounts
Sure.
than they did pre-COVID. And that was to the tune of over $2 trillion at its peak. The consumer has spent a lot of that now, so they don't have as much cushion as we go through 2024. But the fact is that the economy is still strong today in large part because the jobs market is still real good. And I have a couple charts in a minute to look at that, actually. But how far can it go? I think the big question is that the Federal Reserve hiked interest rates from near zero
Yo.
in March 2022.
What are they now?
Started. Their overnight interest rate is 5.5%.
Got it.
Okay. They, in late December, had that big Fed meeting called the Fed Pivot that we talked about, where they said, hey, we're finished with our rate hike cycle. We are now looking at cutting interest rates in 2024. And again, I have a chart for that in a little while
Right.
to talk about how that's going.
And they have given us, they've told us how much they're going to cut it and when they're going to do it, correct?
Yeah, they've given us a projection. But that is just a projection. It can change, especially as we go through the year. If anything unexpected happens, that's going to be something that they can adjust on the fly.
Perfect.
So that's point one that's important to talk about is on the inflation topic. Consumers are not happy that prices are a lot higher than they were a few years ago.
So we're not crazy.
No,
Right.
Absolutely.
Yeah.
When if you hear that, hey, inflation's over, it's past, don't worry about that anymore, that's not exactly true.
Okay.
All right, so point number two, the U.S. economy. And Evan, like we were just talking about in 2023, many economists thought the U.S. was going to go into a recession.
Yes.
That did not happen. And now most of them have thrown in the towel on their call for a recession. In fact, they've gone the other way. They have increased their estimates for how fast the U.S. economy is going to grow. Have you heard of GDP growth?
Yes, gross domestic product.
That's exactly right. Gross domestic product. So this measures how fast the economy is growing here in the U.S. and this is measured for economies around the world. Well, let's look at a chart here, and this is titled "The United States Economists Continue to Boost Their Estimates for This Year's Growth," and we'll put this up.
Yep.
So what this is what economists believe the U.S. economy is going to grow at in 2024.
What do they base all that off of?
It's based on a lot of factors. Sure. It's based on the jobs market. It's based on the services economy, how much consumers are spending. Consumer spending is 70%.
Really?
Of this number. Then we have government spending, we have manufacturing, we have imports, exports.
So if we're spending, our GDP is going up.
Yeah, and that's one of the reasons we've been so, we felt good last year about the economy because we said, look, consumers have jobs, and when they have jobs, they spend. And we also said that consumers had a good balance sheet. And now in 2024, they have spent down in the last couple of years some of that. They don't have as big of a cushion. Take a look first at what economists are saying here. And note that back in 2022, at the start of 2022, economists were projecting 2 years out at that point, growth of around 2%. That took a nosedive throughout 2022 and early 2023, down to less than 1%. But look at what's been happening since last summer.
Yep.
This has been going almost straight up.
And it's not just because everybody's spending all the stimulus money.
No, it's not.
Because I know people are going to think, okay, we gave them a bunch of money, they're spending it, and they're about to run out, and this is going to go the other way.
Right.
So.
Well, one thing that they have going for them is right now, consumers are getting wage growth above the current inflation rates, meaning the increase you're having in wages is exceeding the inflation rate.
I hear what you're saying. It's time for me to ask for a raise.
Yeah, no, absolutely. Absolutely. You should ask for one, but just not for us for one.
That's right.
Don't ask us for one with your role here.
I'll wait a few weeks.
Yeah, absolutely. But this is important is that one of the things early on is that the U.S. economy has been able to handle the rate hikes that the Fed did in 2022 and 2023, going from a 0% overnight rate to a 5.5% rate. And as an example of where that impacts consumers, mortgage rates were at 3%.
Right.
3 or 4 years ago. You remember those days?
I bought a house.
Okay. At that time, you took advantage of that.
Hopefully you did too.
Yeah. A lot of people refied, or a lot of people refinanced. Sure. There were people who have mortgage rates in the 2s. But that rate, because interest rates went up so much, that rate got as high as 8% last fall. It has since come down some. It's sitting now, the 30-year mortgage is around 6.9 today.
Will it ever get back to 2s and 3s?
I don't know that it'll get back there anytime soon. We don't want them that low because if they get that low, that means that the Fed has had to cut aggressively. Now,
that's a good point. So as much as we love low interest rates on homes, as buyers. For our portfolios, and we're talking about our portfolios here, it's not necessarily a good thing long term.
Yeah, I mean,
Okay.
if interest rates go, if the Fed cuts interest rates, the overnight rate to near zero, and then mortgage rates are based off 10-year U.S. Treasury bonds, if those rates come way down, putting mortgage rates back in the twos, it oftentimes means that there is a pretty significant recession.
Copy.
So we would prefer it not to get back there.
Perfect. That's good to know.
A lot of people believe that kind of a neutral mortgage rate is it somewhere between 4 and 6%, in that range.
Healthy.
Yeah, a healthy place for it to be. And again, a lot of consumers would like that to be lower.
I did not know that. Okay,
Yeah,
that's good.
Absolutely. Now, the other chart that I want to show, and I've called this one of the most important charts that we monitor every week. This is U.S. initial claims for unemployment insurance. So
Okay.
you're aware that if someone gets laid off, if they can immediately find another job, then great. If they can't, they go and they file for unemployment insurance.
Yes.
Okay. So this is measured, and the U.S. government puts out this on a weekly basis. Okay.
Weekly. Got it.
Yes. So this chart that I have goes back to 2021 in the throes of the COVID, stretch here, early 2021.
Yep.
Over 600,000 people per week were filing for unemployment insurance. This went down significantly. But take a look since January 22
I see that.
through today. That's over 2 years. And if you take a look at it, we'll put that on the screen there. But if you look at that, this has gone in a tight range for 2 years.
Does that mean that there's jobs to be had and people are just stepping into new positions?
Exactly,
Yeah.
exactly right. There were a lot of people expecting, when economists were forecasting a recession, they thought this would rise to 300,000, 400, 500,000 people per week. That never happened. This stayed in a tight range between around 180,000 to 240,000.
Sure.
And this is a really good sign because it's telling us that when consumers are getting laid off, when workers are getting laid off, most of them are finding jobs quickly. They're
Interesting.
not having to file for unemployment insurance.
So, what is the unemployment rate currently then?
Right now, it is at 3.9%.
Okay.
And that thing has ping pong between 3.5 and 4%.
Okay.
It's going to stay
What
in
was the
that
last year?
range.
At its highest.
Well,
at its
last
highest.
year it got as low as 3.4, and 4% was about the height.
Okay.
The height at
Now,
that time.
I've heard some people say to this, okay, yes, but people aren't taking the jobs. They're waiting. So even though that there's jobs to be had, a lot of people aren't taking the jobs.
Well,
what do you say
I mean,
to that?
there was that happened. That was the case in 2021 and early 22 that a lot of people stayed home.
Yep.
They, especially while the stimulus was so significant.
sure.
The,
That
the-
makes
the
sense.
boost. A
Yeah.
lot of people. Yeah, there were a lot, especially at service jobs like restaurants or at the mall or any concert places. Those kind of jobs, a lot of people said, hey, I'm getting paid more to stay at home. Why would I come back and start working? So that was a problem for a lot of small
Right.
businesses and even larger businesses for a period of time. That's really not a problem today. though.
Okay, good.
Yeah.
Wondering about that.
All right. So any other questions on this topic?
Good to go.
All right, let's get to topic 3. Okay, for our last topic for today, the Federal Reserve. And this is something that nerd alert when we start talking about this.
I was about to
okay?
say I'm starting to
Yeah,
doze
you're
off
starting
already.
to doze off here.
Yeah.
So we'll try to keep this simple here. Last week, the Federal Reserve met. They meet every 6 weeks,
Sure.
and Fed Chair Jerome Powell does a press conference. And this was every time in 2022 and 2023 that they had a meeting, it moved the market significantly. What is cool is that last week they met.
Sure.
And they talked about the fact that they have been projecting 3 interest rate cuts for 2023 or 2024. Yes, 3 interest rate cuts. Just 2 months ago, the market was pricing in 7 interest rate cuts. They were going to say, look, the Fed is going to have to cut rates significantly
yeah.
as we go through the year. We stayed in the camp that we don't really want the Fed cutting that many times because that oftentimes means the economy is really starting to struggle.
Sure.
Okay. They've been able to hold to the projection of 3 cuts. The market is now only pricing in 3. And the cool thing, Evan, is that the stock market has not gone down, even
That's
though
right.
even though pricing has switched like this.
Sure.
Because for a long time it worked this way. If the Fed was saying we're going to have to hike more, the markets were crashing. Okay, now maybe not crashing, but they were dropping significantly. Okay. On the flip side, when the Fed would say, "Hey, we're done with the rate hikes," the market celebrated that in December. So what's been cool in the last 2 months is that the stock market has not declined, even
been brilliant,
though the market's gone from saying the Fed's going to cut 7 times to just cutting 3 times.
Well, I'll tell you, it's confusing because you look at the market, we got all-time highs and stuff like that. As an investor, I was like, okay, well, obviously, and I've learned this somewhat from y'all, when it's high, you wait a little bit. You're a little more cautious. When it's low, you try to buy. So now, as an investor, I'm like, well, do we put more money in? Bitcoin's at an all-time high. Is it about to take off to the moon?
I know this is a topic that you
Sure.
like, and so to at least get our thoughts on it.
It's just so topical. People wonder, hey, am I missing out?
Yeah. Well, listen, the fact is that Bitcoin has had a wild ride over the years, and our stance has been the same all throughout. Meaning when Bitcoin in 2021 was up at 69,000,
right?
When it went as low as 15,000 back a year or so ago, when Sam Bankman-Fried and FTX
he's in jail now.
Yes, he is in jail, and now it's back up above 70,000 or right around 70,000, and it is a very volatile, high risk, high reward, speculative investment.
Would you have anybody in that? What percentage?
There are a couple of my clients who just had some interest in it, and we have a small percentage of their portfolio, 2-3% in it. But it's only a handful of my clients, okay? 95% of our clients are not in it and never have been.
Sure.
And that's just because there's no cash flow with Bitcoin. There's no dividends, okay? It is, the price of it has everything to do with sentiment of investors.
Is it gambling then?
I wouldn't go so far as to say gambling, but I'd say that there's a lot of factors in the future. What happens, let's take the Chinese. They don't want to have anything to do with Bitcoin. They've banned it over there. And we have it here in the US.
Yeah.
The SEC hates Bitcoin. They approved, Gary Gensler, the head of the SEC, approved Bitcoin ETFs a few months ago, and that really drove the price up. Bitcoin is trading around 35,000 before speculation came out that the Fed or the SEC was going to approve Bitcoin ETFs.
Yeah.
Okay. It's gone from 35,000 up to 70,000 ever since those started to trade. But he said, you remember the quote we said in one of the videos where he called it rat poison?
Yep.
And I mean, and we've also had
Warren Buffett
say rat poison. But Gary Gensler said it's illicit for criminal activity.
Sure.
They don't like it. And so the fact is there could be a point in the future where they bring the hammer down on these things. So it is very speculative. If you put money in it, be prepared. Bitcoin could be at 150,000 a year from now. It could be down
and
at 20,000.
And then drop to 20,000,
Exactly. And so for that point, it is nothing more than a speculative asset. If you want to take 2, 3, 4% of a portfolio as kind of a lottery ticket, nothing wrong with that. If that's your game, more conservative clients don't have anything to do with that.
Makes sense.
All right. Any other questions for today?
So I was looking at a couple stocks. I was looking at Tesla, and it was unbelievably low. Wondering if it's a buy. Looking at Disney, unbelievably high over the past 6 months. Tesla seems like it's doing a good job of managing its company. Disney looks like it's doing a bad job of managing its company. When you see those kind of things, like, that's what confuses me. It's like, okay, are these long games that I don't see? is the market doing?
We, years ago, when Disney announced their streaming service, we bought the stock. We held it for a couple of years. And then when it became clear that they had many challenges,
Sure.
about maybe a year and a half ago now, we sold it.
With Disney Plus and their governance issues.
Yeah, exactly. And then it dropped about another 40%. And then it stayed between $80 and $100 for quite some time. It's up around $115, $118 now. But the problem is that they've got issues. Nelson Peltz and Triad are coming in trying to get board seats. They don't like the job Bob Iger's doing. Bob Iger has come back retired multiple times.
Sure.
And the fact is he's having a much tougher time now than he anticipated when he came back. To us, it's a no touch in client portfolios. On Tesla's stock side, look, Tesla's stock back in 2021, it was the it stock. Nvidia is the it stock now.
Oh yeah, we got Nvidia.
But the fact is that Tesla was that at that time. They've run into some troubles. They've had to cut prices for their vehicles multiple times over the last year. They have competition in China that is pretty tough. But the fact is that the stock had a peak of $414. It's around $180 now. It's dropped significantly. It's now disliked. Very negative sentiment.
Sure.
And the fact is, if you look at the 7 or 8 largest kind of tech names, and Tesla gets thrown in with the Nvidias and the Metas and Amazons, etc., whenever one of those companies has been hated or disliked, normally the stock has done really well in the next 6 to 12 months. So it's something that it would not surprise me if 6 months or 12 months from now, it's higher than it is today because it has dropped significantly.
It was up 5% today. I don't know if that's a predictor. I know everybody's asking the same thing. When the stock market gets to where it's at, I know you guys keep an eye on it. And that's where sentiment for us as investors needs to kind of be opposite of the market in some sense. Yeah.
So what you're talking about there is investor sentiment. When investors are very bearish, when they're not feeling good around the market, a lot of times that's when you want to put money to work. On the flip side, when everyone loves the market, when it's hitting all-time highs, when people are checking their accounts 3 times a day because it's hitting new records, those kind of things, you want to be a little more cautious. Because a lot of times when that happens, and by the way, that's when you have more speculative assets tend to be going up a lot. You remember back the GameStop and AMC phenomenon.
What do you call those again?
Meme stocks. And those dropped, a lot of those dropped about 90% back from their 2021 highs. Of late, in the last month and a half, a lot of those have gone up 40, 50% again. There's a lot of excitement around it. So it's just when we see a lot of enthusiasm, we want to be a little bit more cautious.
Okay.
And so that's a very good point you make.
One of the things I've liked about Centauri is that I do feel confident that if I'm not paying attention, I do some just for fun. I pay attention to it, just watching it for fun.
Sure.
But I like the fact that I know that you guys are actually nerding out on this, actually churning through the data, actually 2008 hit, y'all were ready. Your fingers was on the button. You move stuff around. That to me is a big plus. So excited.
Well, very good. Well, listen, great having you again today.
I'll be back.
You brought a lot more class to the room, I think, is what some of my clients said when you saw it in the video versus me by
Learning
myself.
from the best.
Yeah, absolutely. Well, hey, thanks again for watching. Again, don't forget to like and subscribe. We will be back in 2 weeks for the next market update. Take care. Thanks so much for watching our video. This one today was a little bit longer. Every so often we take a deeper dive when we have client questions on topics. In 2 weeks, we'll be back with a shorter video. And listen, if you have an advisor that you don't hear from or who doesn't give market updates, go to CenteraCapital.com, go to the contact page, and we will set up a phone call where you can talk to one of us and set up our first appointment. Thanks a lot and have a great week.